Good morning. My name's Patrick Malcolm. I'm a senior partner at GFM Wealth Advisory. Thank you to all our clients and guests for joining us today for our webinar with Aoris Investment Management. Now, we're very fortunate to have two people from Aoris Investment Management today. We've got Stephen Arnold and Delian Enchev. Good morning, Stephen. How are you?
Well, thanks, Patrick. Good morning to you.
Good morning, and good morning, Delian. How are you?
Well, Patrick, good to see you.
Now we've got two firsts today, two webinar firsts. We've got Delian, who's actually joining us from the UK today, and it's almost 11 o'clock at night over there. And I think the other thing too that's a little bit of a first is, Delian, I've never had the fortune of interviewing someone that's younger than me, so that's great. That's a first. That's a second first. So thank you very much for joining us with the time difference today. We really appreciate it. Now, first thing that we need to do before we start the webinar is just to share our disclaimer, which is shown on the screen there. So I think all of our clients and guests understand that this advice is of a general nature today. It's not specific to your circumstances. If you do require advice that's with regard to your personal circumstances, please contact one of the advisors in the office. So we're going to start with a pretty simple question to lead off, Stephen. So Aoris, can you, just to start with, outline your investment philosophy and why you have chosen that particular approach when it comes to investing?
I'll be delighted to, Patrick. Maybe I'll preface the answer by talking about our business principles before we talk about our investment principles, because we think the way that we've structured our business will be helpful to allowing us to do our best job for our clients. And there are a few of them. The first thing is that we are a single strategy manager. We're here to do one thing and do it well. The second thing is that we think ownership is important, and Aoris is a staff-owned, privately owned business, and we think that that's a better structure than where we publicly owned or to sit under the umbrella of a broader financial services group. The third thing is that we're aware that the quantum of money that managers look after can affect their performance once it reaches a certain size. Aoris is a 6-year-old business today, managing $1.2 billion of assets. And we've said that based on market liquidity today, about $5 billion is the level that we think that we wouldn't be comfortable going through. So we're capacity constrained, very much with an eye on not allowing the amount of money we manage to impede our ability to do a good job for our clients. Okay, so turning to investment principles, Patrick, we see ourselves very much as business owners. We want to own businesses that become progressively more valuable over time, where the risk of a disappointing outcome is low. In our portfolio today, you'll see businesses like L'Oreal, LVMH, Microsoft, fantastic less well-known businesses like a Copart and an Amphenol. And in order to, the characteristics we're looking for are businesses that are consistently profitable, businesses that have been around a long time. So there's a lot of proof points of how this business navigates difficult conditions, how hard are they to compete against. We want businesses that grow. It's hard to become more valuable over time if you don't grow. Now, growing in line with a growing market is good, but it's not really good enough. We want businesses that grow faster than their peer group. That starts to speak to something that's a bit special about that business. All of the businesses in our portfolio today are leaders in their market, and all of them have strengthened that leadership position over the last 10 years by growing faster than their peers. We want businesses that have the ability to reinvest the free cash the business generates in ways that are wealth creating. We want businesses with strong balance sheets. We never know what's around the corner, but businesses with conservative capital structures will be better positioned than those with a lot of debt. We want business with strong corporate cultures that keep their customers and employees a long time. And lastly, price matters. We want to have all of that at prices that represent at or below fair value. Now, an important part of our portfolio is that we are very selective. We own just 15 businesses, and by owning as few as 15 businesses allow us to be very selective, very discerning, keep those quality criteria very demanding, such that, and also be very thoughtful about our investment decisions. So there's a lot in that, Patrick. In a nutshell, we're business owners. We want to own successful, growing, wealth-creating businesses, and that will be the engine to our expected investment returns.
Sounds very easy, Stephen. Sounds very, very easy. But anyway, now, the fund's had an unbelievable performance in recent times. It's made 36.1% over the last 12 months, which is significant outperformance over the index. Now, what I find most intriguing in terms of the performance, Stephen, is you only hold one of the Magnificent Seven, and we won't be able to have a webinar today without talking about the Magnificent Seven. I found an interesting acronym for the other 493, Stephen, and that was the mediocre 493, the other 493 stocks that are in the S&P that aren't the Magnificent Seven. Now, can you tell us how your fund has performed so very well without holding, or with only holding one of the Magnificent Seven, which is Microsoft?
Well, Patrick, as you said, the portfolio has done well over the last period of time, but our eyes very much always on our 5 to 7 year long-term outcomes. And we can circle back in due course in the conversation, talk about how we see the valuation today, but it's very much the medium to long term we're shooting for. Now, in terms of the contributors to return, I think the last year was quite interesting. There was all the media where attention was on the exciting large technology businesses. We own Microsoft, but we don't own 99 of the top 100 tech businesses in the world. We own just one of them. But across our portfolio, we had a good handful of businesses that increased by more than 40% last year, many of whom people rarely read about. That would include Costco, which is a terrific US retailer with a presence in Australia, including Victoria, including Cintas, a uniform rental and facility services business, Fastenal, which is an industrial distribution business. It sounds boring, but it's a terrific business, and the outcomes have been far from boring. So I think that it goes to our comfort, not feeling like our portfolio has to look like everyone else's, our ability to find quality and attributes in areas, types of businesses that may not sound that exciting, our discipline in the valuation, the prices that we pay for these businesses. And by being so selective, I think we're able to end up with a good intersection of quality and value in a way that would be much more difficult if we own more stocks.
Thanks, Stephen. Now, you went through a very sort of detailed process about how you look at companies and the businesses that you like to invest in at the start. Of the non-Microsoft Magnificent Seven, i.e. the other six, do any of them come up on your radar, Stephen, as quality businesses to own, or are they quality businesses that are just too expensive, or how do they sort of fit in terms of how Aoris sees the world?
Patrick, they're all quite different businesses, so it'd be hard to make general statements.
Yep.
There's, NVIDIA does something that the world needs a lot of, and it's very difficult to create the microprocessors, the chips that NVIDIA does. Amazon's been an extraordinarily successful business in its field of operations, and Apple and the other businesses have got deep competitive advantages. Look, some of the things that keep those businesses out of the portfolio include, the narrowness in some of those businesses. We like businesses that are broad, that do many things for many customers in many markets. Microsoft being a good example, that don't rely on one or two products in a way that creates fragility for a business. If someone comes up with a better Gen AI microprocessor, then that will be quite material for NVIDIA. Naturally, their customers want to pay less for those chips, and many competitors want a piece of the action. But because its business is centered around that relatively narrow sphere of activities, it creates a fragility to the business that we shy away from. Businesses that are growing very fast, sometimes it makes it hard for us to judge, well, what is a normal level of profitability? What's a normal level of growth for that business? That can be a challenge. Growth, of course, attracts competition in ways that makes it hard for us to judge, well, as this market settles down and growth becomes a bit more normal, what will the competitive structure look like? What will profit margins look like? So that's where we shy to businesses that have breadth. The markets are a bit more mature. We can make a more confident judgment about who is the leader in that market because it's been demonstrated for a long period of time. So that's, and we're able to make successful investments in, as I said, businesses that are quite different from those creating all the AI excitement with the companies like Fastenal or Costco.
Thank you. Now, Delian, in terms of sort of picking up on Stephen's first point around the best businesses and the rest, can you perhaps discuss the attributes that separate the very good businesses that you like to own in the Aoris portfolio from the rest?
Yeah, sure. I think Steve already touched on many of the attributes of quality that we look for in a business. And those are the attributes that are developed, help develop those into market-leading businesses. A lot of the time, the secret sauce of the best businesses, it's not so much about what they do, it's about the way that they're managed, their culture, and the way that they operate. And we want to own businesses that are managed for the long term, as Steve said. They earn a good return on the capital that the management invests on our behalf. And they do right by their customers and their employees. And they're rewarded with good customer retention and growing customer spend. So I'll give you an example. Steve mentioned we own Costco. And almost anything you buy from Costco, apart from its beloved Kirkland products, you can buy somewhere else. So what it does, it's a retailer, it's not what makes it special. But why do 130 odd million consumers around the world choose to pay for a membership from Costco for the privilege to shop there? The main thing is they know that Costco is working hard every day to bring them the lowest possible prices and not trying to maximize its short-term profits. So it's committed to not marking up its products by more than, I think, 15%. Whereas if you go to Coles or Woolies, the products are marked up by double that, more like 30%. And in periods of high inflation, like in the pandemic, Costco said, we'll be the last ones to raise prices on customers. And in periods like today, where there's been some deflation in product prices, Costco is saying we're the first to cut prices. So members know what they're getting, and it's a mindset of taking care of the members and giving them value, not trying to maximize the next quarter's earnings. And then, the second thing I want to mention on Costco quickly is it takes care of its employees, and in turn they're incentivized to deliver great service to customers. And one of the anecdotes I love sharing is that every store manager in Costco and almost every senior executive has come up through the business from the store floor. And so they actually had a new CEO join a few months ago, and he started working at Costco as a forklift driver more than 40 years ago. And so employees see that it's a place they can actually grow their careers, which is not the case for most of retail, and it incentivizes them to deliver exceptional service to customers.
Interesting. Now, Delian, the most important thing about Costco, my children want to know this, is the hot dog still $1.50?
It's still $1.50.
Incredible.
I think
it's quite
one of the
incredible,
prize there's a
I'm
famous
tempted
line.
to take them into Costco to buy a $1.50 hot dog rather than taking them to McDonald's, but that's okay. Now, I'm sort of picking up on that consumer centricity. The portfolio's got quite a few stocks that are sort of consumer names. And I think the view sort of looking back when rates started to increase, there was a view that maybe the consumer, anything that was consumer centric wasn't the place to be. So how has the portfolio sort of overcome that theme and generated that sort of good recent performance with perhaps that sort of headwind that it's faced in recent times?
I'd say in general, we have a strong preference for investing in businesses that serve other businesses. Business customers, they tend to be more loyal, more willing to pay up for better service, compared to consumers that can be fickle. They like trying new things. They might be more budget conscious. So of the 15 businesses that we own today, 12 actually serve other businesses, not consumers. And of the 3 consumer-facing businesses, I think they're all exceptional in their own ways. I've already talked about Costco. The company reported last week, actually. Revenue grew by 7% in the quarter, which has slowed a bit because of lower price inflation, primarily. But the most important determinant of the long-term value of that business is the growth and the retention of its membership base. And its paying member base grew 7%, and it's got retention rates of over 91% for the members it has. So it's in very healthy shape. And the other two are LVMH, the world's largest luxury goods business, which you may know some of its brands, Louis Vuitton, Dior, Hennessy Cognac, and L'Oreal, which is the world's largest maker of beauty products. In the last 12 months, both of those companies have reported very strong growth, even in the face of some of the pressures you've mentioned, and where many of their peers didn't. So to give you an example, LVMH grew revenue 13% last year, despite a slower economy in China, which is a big market for it. And L'Oreal in the last 12 months has grown its revenue by double digits compared to its largest peer, whose revenues declined by a similar rate. So they've really stood away from the peers.
Don't think we could get two stocks at opposite ends of the spectrum, Delian, Costco and Louis Vuitton. I can't imagine there's a heap of cross-pollination of customers across the two businesses, but that's okay. Now, Stephen, an interesting business that we hadn't heard of, Copart. So stock's done amazingly well. I think it's up about 60% over the last 12 months. So can you talk about Copart as a business, and how do you uncover an opportunity like that to add to your portfolio?
Well, you're right. Copart's a super interesting business that we rarely hear about. Copart is the largest auction platform in the United States for selling vehicles on behalf of insurance companies where the car has been deemed a total write-off. So that's quite a mouthful, but if imagine on last weekend, somebody had an accident and the insurance company is making a decision, do I pay to get this car repaired and get it back to its pre-accident condition, or alternatively, do I give the car owner the insured value, take possession of the vehicle and then sell it and get the best price possible? Now, over the last 20 years, the percentage of vehicles or percentage of accidents that have resulted in a car being deemed a total write-off has increased significantly. And today it's 20%. 1 in 5 accidents results in a car being written off. That was less than half of that a decade ago. And you can imagine that as cars have more electronics, the cost of repairing, the labour costs become significantly higher, and it pushes more vehicles into the salvage market. It's a two-player market. Costco is significantly larger than their nearest peer, and Costco has gained a lot of market share over the last 5 years in a growing market. So it's a business that's run very, very much for the long term. They've, to give you an example, more than 20 years ago, they moved their business to be entirely online only. Their major competitor did that only in 2020. And Copart's developed a very significant base of buyers in overseas markets that are interested in purchasing cars from America and perhaps benefiting from cheaper labour costs and repairing them and putting them back on the road. So it's a business that we can look forward for many years and be confident that it'll continue to grow profitably and become more valuable, deepen and strengthen its competitive position. Now, how do we discover businesses like this? It's comes from a combination of having a very clear idea of what we're looking for. I think that gets to the root of it. If we have a very defined sense of the sort of businesses that will end up in the Aoris portfolio and the characteristics that they embody. So by reading widely and paying attention to reading The Economist and Wall Street Journal and Financial Times, sometimes running quantitative screens, using a database to tell us what businesses quantitatively have the attributes that we're looking for. That's, of course, only part of the process of uncovering the real attributes, the management mindset that Delian spoke about, that makes a business truly interesting, but it can be a useful starting point. And then lastly, travelling across...
Can I ask whether you do a company visit to Copart?
Yeah, we do. We talk to the company. We try and get overseas to wherever they're based. Delian will be travelling through Europe and the UK in June, and myself and a colleague will be in the US and going to all sorts of places where businesses are, and then that's a useful mechanism to uncover some hidden gems. And then, as I said, we've got a clear sense of what we're looking for, which allows us to quickly move on from something that looks just okay and really focus our time and attention on businesses that look truly interesting.
Good. Now, you're right, an annual investor letter each year, Stephen, which we always think is a great read. There's another famous investor based out of the US that does an annual investor letter as well, which is also a very, very good read. I must say, Stephen, I find it to be a bit masochistic. Why do I find it to be a bit masochistic? Because you seem to take as much joy in learning from the losers as talking about the winners. So I'm going to ask if that's true and why it's the case. Why do you really enjoy learning from the things that perhaps haven't worked in the portfolio as much as the things that have worked in the portfolio?
Oh, it's a great question, Patrick. And look, we get excited about learning. We recognise, and I think you've got to start with the mentality that not every decision we made last year was optimal. I think, like in football, if you say that all the goals you conceded were because the wind was blowing the wrong direction, it was raining in the second half, and the referee was blind, then you're really inhibiting your ability to learn. So we try and be objective as much as possible, and look at decisions we made and think hard at the end of the year about how can we tune our process, our thinking, how we operate as a team, to learn from those decisions. Investing's, you can get good outcomes from poor decisions and vice versa. So it takes humility and objectivity as much as possible to work out which is which, and then work hard to make small improvements. And then lastly, try and make those improvements lasting. It's one thing to say, okay, let's do things a slightly different way, and then forget about it 3 months later. We work hard to make small improvements that become cumulative, and little by little feel like we're learning and operating more effectively.
Good. And Nike was a company that you used an example in the last investor, Stephen, as one that, maybe that you've learned from. Can you talk us through sort of Nike, because it's a very well-known company that all of our clients would obviously resonate with, and, what you've learned from that and maybe what you got wrong there?
Yes, we've owned Nike for a few years. It was a successful investment for us. We trimmed the position in the portfolio about 18 months ago, and then sold it in the second half of last year. In hindsight, we should have sold it earlier than we did. It's a business that's got a terrific long history of growing, repelling competition, but it's one where we feel maybe the competition it faces is becoming a bit more difficult to deal with. You've had some small brands become quite large in footwear, in Hoka, and on running, areas where Nike has traditionally done well, sort of performance footwear. And then in China, you've had some local brands do particularly well in the last few years, perhaps benefiting from strong nationalistic sentiment there. So as Delian said, we prefer businesses that sell to other businesses, and Nike is in an industry where consumers have an appetite for new things. The barriers to entry can be low, and market shares can move in a more fluid fashion than for most of the businesses you'll find in the portfolio. So those are a few things that we've thought hard about and will take into the decisions we make in the future.
Good. Now, I don't think we can, just like talking about the magnificent, Delian, I don't think we can go a presentation without talking about ESG, which I think is a positive trend that's emerged in investment management over the last few years. So can you talk us through how Aoris views ESG when it comes to investing?
Yeah, of course, Patrick. It's quite ingrained in our research process and helping us form a judgment on the quality of a business, because at the end of the day, we believe that if businesses aren't good stewards of the environment and their resources, if they don't treat their employees well, their customers well, and have a negative impact on society, if they have poor governance, then their competitive strengths aren't durable, and they carry higher investment risk. So we think those are all key attributes in determining the quality of a business. And how do we form that assessment of ESG? We start with what we don't own, which is a lot, as Steve mentioned. Very selective. We choose not to invest in emerging markets because of poor governance. We choose not to invest in sectors like pharmaceuticals and banking, in part because of their poor business practices and selling practices. We choose not to invest in mining and tobacco companies because of their unsustainable societal environmental impacts. And that's what they do. And we'll look at things like behavior. So are they engaged in any regulatory lawsuits or penalties and so on that might indicate poor behavior? And then on the positive side, what are the positive signals? Businesses with high rates of customer and employee satisfaction and retention, as I mentioned before. Businesses that have low workforce accidents rates or disputes, have good relationships with their employees, no material, legal, or regulatory penalties. Businesses that communicate clearly to us, especially when things are going wrong. Business will never be smooth sailing, and we want to hear the good and the bad. And finally, the direction of change. So is the business working to get better? No business is perfect, even those with the best ESG assessment in our view. So what are management doing to improve and to remedy any existing ESG concerns? We assess all those in our research. We vote at all the AGMs where we think there's a material issue, and we clearly outline what ESG means and what investors can expect from us on our website, as you said.
Now, Stephen, we're definitely in the information age where there's so much data that's readily available at our fingertips. I don't think a day goes by when I read about artificial intelligence effectively meaning that all portfolio managers will have no job at some point in time. You made a really interesting comment, which is that investing is about judgments, not the quantity of information. So can you unpack that for us?
It's an interesting topic, Gary Patrick. I think sometimes investors maybe can lean heavily on the quantity of information and data as being the source of making good investment decisions. People will look at queues outside Louis Vuitton shops, or they'll send drones over Costco car parks and trying to sort of get the micro detail, or they'll trawl the web for little signals. The approach that we take is we want to step back and understand why the business is as strong as it is, what motivates management, how they treat their customers, their employees, what can we expect in the future, how difficult is this business to compete with. And these are all judgments. You need a certain base level of information in order to inform those judgments. But after that, additional information can sometimes actually become unhelpful and can encourage you to focus perhaps on the minutiae rather than on the bigger picture. So it's judging a company's strengths, its behaviour, its motivations, to inform our view of the trajectory of the business and the risks around that. Is how we think about why judgments and insights are the key to good investment decisions rather than the quantity of information.
Thank you. Now, Delian, I know Aoris are stock pickers and we don't take sort of views about the macroeconomic environment or markets as a whole, but I can't sort of not ask, how does Aoris feel that valuations look given the strength that's been prevalent in markets in recent times, albeit it's been a recovery off somewhat of a low base?
You're spot on, Patrick. We don't spend much time thinking about equity markets in aggregate.
I love trying to pin stock pickers on a question like this.
or how the valuations of our companies compare to the broader market, because there are lots of businesses within the broader market. But we value the businesses that we own based on their individual attributes, the strength of their competitive moat, their management teams, their balance sheet, their earnings growth. And based on those appraisals of valuation that we've come to, we think our portfolio companies trade on average a 15% discount to fair value today. And that's even after the run we've had in markets over the last 12 months. And that valuation gap has narrowed a bit, for sure, but we still expect it to contribute positively. And if we own the businesses on average for, say, 5 years, it'll add a few percent to our investment return per annum. But we also work hard to preserve that valuation discount. If we just sat and did nothing, that would have narrowed. So firstly, if we think that a position in the portfolio is fully valued and we have more attractively priced candidates on the bench of equally good quality, then we'll make a full position change. We'll sell one and bring in another. But our cap is 15, so it's got to be one in, one out to keep our best 15 ideas. Owning 15 businesses lets us be highly selective on quality and also valuation, as Steve mentioned.
Yeah,
really. Secondly,
sorry, go on, Dalian. Sorry.
No, sorry, Patrick. And secondly, I was going to say, of the 15 that we do own, we actually weight them within the portfolio based on their discount to fair value. So we periodically reallocate more of our clients' capital to our cheaper ideas and helping preserve that valuation discount.
Thanks, Dalian. And I think that's a really good segue into our last question, Stephen. So, as Dalian's spoken about, a 15 stock portfolio, it's pretty punchy. Does that sort of lead to a high level of turnover or a low level of turnover? And sort of referencing that, can you maybe talk about some of the changes that have been made to the portfolio in recent times?
Yeah, sure, Patrick. I think clients can expect us to replace 3 or 4 stocks in full each year. And then the topping and tailing of existing positions that Dalian referenced will sum up to about 30% of the portfolio capital changing each year. Some years a little higher, some years a little lower. Last year we made 2 changes. We've made 1 so far this year. So in addition to selling Nike last year, we sold an interesting US-based specialty industrial business called Graco. They make fluid handling and dispensing equipment that's used in a variety of applications, including paint spraying, which we felt was a great business that was fully valued. And we replaced it with a European specialty industrial business called Atlas Copco that has global strengths in markets like air compressors, pneumatic equipment, vacuum technology, and so on, that we felt was trading a much higher discount to its fair value. Earlier this year, we sold a US retailer that operates in rural communities in the US called Tractor Supply. It doesn't sell tractors, by the way, but it does sell a lot of goods that people need to run properties and hobby farms in rural communities, including animal feed. And we repurchased a stock that we had owned several years ago in the portfolio called Compass Group. Compass is the largest contract catering group in the world, that they feed people in places of work, hospitals, universities, sporting stadiums, and remote mining sites, where we feel it's become a stronger business post-pandemic, and it's by far the largest in the market in which it operates, and there are significant benefits to being the largest. So that's our most recent portfolio change.
Thank you, Stephen. Dalian and Stephen, really appreciate the time you've taken today to speak with our clients. Dalian, especially appreciate your time, given the time difference in the UK. Thanks again, guys. Really appreciate your time. Stay well.
Thank you, Patrick.